Hello guys, what's up? Welcome back to my channel. This is your Karsh Bachchani, and in this video we are going to perform uh, how to perform a financial analysis of the company. So guys, let's go. We perform financial analysis of the company on the basis of few ratios. What type of ratios are? There are five types of ratio. On these ratio, we measure the financials of the company. Number one, activity ratio. Number two, liquidity ratio. Number three, solvency ratio. And number four, profitability ratio. And number five, valuation ratios. So guys, let's go. Activity ratio. Activity ratio is used to analyze that how company utilize their assets, how efficient the company operations are. Categories of activity ratios. Number one, working capital. Number two, fixed assets. And number three, total asset. Working capital. So working capital is nothing, just it's a capital which company requires to for their day-to-day operations. The working capital is also referred as to a operating capital. It is the excess of current assets over the current liabilities. The level of working capital provides an insight into a company ability to meet current liability as they come due. Components of working capital: receivables, inventory, and payables. Receivables. The account receivable turnover measures how efficiently a company is able to manage their credit sales and convert its account receivable into a cash. How it's calculated? It's calculated by total revenue divided by average receivables of the company. Number two, inventory. Inventory turnover measures how efficiently a company is able to manage its inventory. Inventory turnover is calculated and equal by cost of goods sold divided by average inventory. Number three, payables. Payables turnover measure how quickly a company is paying off its accounts payable to the creditors. It will be calculated by cost of goods sold divided by average payables. So guys, let's talk about activity ratios. Second category, fixed assets. What are the fixed assets? Fixed assets are the non-current assets and are tangible long-term assets that are non-operating, that is not used in the day-to-day activity of the company. Fixed assets usually refer to a tangible assets that are expected to provide an economic benefit in the future, such as property, plant and equipment, furniture, machinery, vehicles, building and lands. Components of fixed assets are fixed asset turnover ratio and total asset turnover ratio. So guys, fixed asset turnover ratio is calculated by total revenue of the company divided by average net fixed asset. It's measured how efficiently a company using its fixed assets. Total asset turnover ratio is calculated by total revenue divided by average total asset. It's a high ratio, indicates that a company is using its total asset very efficiently, or that it does not own many assets to begin with. A low ratio indicates that too much capital is tied up in asset and that assets are not being used efficiently in generating revenue. Liquidity ratio. Liquidity ratio is used to analyze the company's liable to pay their short-term cash expenses or not. This ratio include current ratio, quick ratio, and cash ratio. Current ratio is calculated by current asset divided by current liabilities. Quick ratio is calculated by cash plus marketable securities plus receivables divided by current liability, and cash ratio is calculated by cash plus marketable securities divided by current liabilities. Solvency ratios. Solvency ratio examines a firm's ability to meet its long-term debt and obligations. Solvency ratio include debt to asset ratio, debt to equity ratio, debt to capital ratio, debt to EBITDA ratio, and asset to equity ratio. So debt to asset ratio equals to total debt divided by total asset. Debt to equity ratio equals to total debt divided by total equity. Debt to capital ratio equals to total today's debt divided by total debt plus total equity, that is whole capital. and debt to EBITDA ratio equals to total debt divided by earning before interest, tax, depreciation and amortization. Asset to equity ratio equals to total asset divided by total equity. Profitability ratio. Profitability ratio is used to measure and evaluate the ability of the company to generate income, profit relative to the revenue, balance sheet, assets, operating costs, and shareholder equity during a specific period of time. There are 8 types of profitability ratio: gross profit margin, EBITDA margin, operating profit margin, net profit margin, cash flow margin, return on assets, return on equity, and return on investment. That is also called ROIC. So in last, gross profit margin is calculated by gross profit of the company divided by total revenue. It compares gross profit to sales revenue. EBITDA margin. EBITDA margin is calculated by EBITDA of the company divided by revenue. Operating profit margin is operating profit divided by total revenue. Net profit margin is calculated by net profit of the company divided by total revenue of the company. Cash flow margin equals to cash is calculated by cash flow from the operating activities of the company divided by total revenue. So guys, if you find this video truly insightful, then please like, share and subscribe my channel, and please share your feedback in the comment box. And in my upcoming video, I'm going to teach you about the MS Excel, advanced MS Excel, and in uh, advanced MS Excel and financial modeling and valuation. If you are a investment banking aspirant, then please like, share and subscribe my channel. It will be truly informative for you. Thank you.